Now, a lot of people are very happy that gold is going up, especially Indians, because Indians stack gold like no other commodity. The question is gold not a commodity anymore? And the reason I ask this is because it's going up in a way that almost makes it seem like an alternate reserve currency back again, back to what, 1970s. And well, two people who track this very, very closely, gold that is, amongst other things. And it's my absolute delight to have two brilliant minds on this conversation with me. Dr. Edward Yardeni, all the way from the US, and much late for him, but appreciate him staying back. And Naresh Kataria, all the way from Chennai, in our studios here to talk about this very important topic. Gentlemen, both of you, really appreciate you taking the time out to talk about gold at a difficult time. It was probably easy $500 before. At 3,000 or beyond, it becomes difficult to maybe give a bullish prediction, but I would love to know, what is your sense? Dr. Yardeni, can I start with you? What do you think is the key reason why we've had such a stellar rally in the yellow metal?
Well, when we saw it break out above 2,000 last year, we concluded that there was something going on here that was likely to continue to drive gold prices higher. And you didn't really need to have a PhD in economics or more than a high school degree, because the news was that central banks were buying gold. And the reason for that was when Russia invaded Ukraine, the United States froze the reserve assets of Russia. And so a lot of central banks that in countries that don't have share the interests of the United States government concluded that maybe they should have more gold and a lot fewer dollars. And so I think the steady ascent in gold is that simple. I think it's really mostly related to the ongoing purchase of gold by major central banks. And if you just take a very simple trend extrapolation, I think it could get to 4,000 by the end of this year and 5,000 by the end of next year and maybe 6,000 before the end of the decade.
Wow. Well, Dr. Yardeni, I must tell you, I can end the show right now, because all people who are watching this, especially people in India, will be very happy listening to this forecast. But Naresh, can I get you in on this conversation as well? Because a lot of people would say this, right? That history may not repeat, but it definitely rhymes. Is there something to... You look at that very, very closely, and the predictions notwithstanding. Is there something that we can learn from history which could tell us something about the current price movement of gold and what could happen possibly in the future?
So I think it's event similar to what happened in 1970s, Neeraj, where US closed the Bretton Woods window and went back on the promise to convert dollars to gold. And as Dr. Yardeni suggested, alluded to, the freezing of Russian foreign exchange reserves, I think, was a similar event. Countries are trying to de-risk the geopolitical angle to the foreign exchange assets, and they are buying a lot of gold. And very interestingly, retail is just warming up. That's very different. So it is a little different. ETFs have been popular for about 25 years in gold, and gold tonnage and gold price usually move in tandem, because investors are performance driven. But this time, the gold ETF tonnage cumulatively across all ETFs worldwide is below the 2020 peak, while gold is up 50% from the 2000 peak of 2020. So it's something really different moving, and I believe it is central banks, and not just
Dr. Yardeni said.
I'll just extend it further. Probably central banks are buying more than what they're disclosing. That's the current account data of import-export, which is suggesting. So yeah, I think it's a very interesting setup in terms of how retail is just warming up.
Could you elaborate on that? And I mean, is there hidden buying happening in gold? And Naresh, a follow-up to that, if your hypothesis is that retail starts buying now, following the performance, if you will, watching this show, if you will, does that lay the foundation for the price targets that Dr. Yardeni spoke about? I mean, it may not necessarily hit in the timelines and the same targets. I'm sure Dr. Yardeni is probably saying that, knowing that too, but just trying to understand if you believe that could be the backstop.
So if I step back, gold moves in very long cycles. So there was a bull market in 70s, 71 to 1980, gold was up 18x. in that period, $44, $45 to $800. Then there was one more cycle, 2000 to 2012. I think gold was up from $250 to $1,800. So gold moves in very long bull and bear cycles, and the tailwinds and the triggers are there. I don't want to place a target, but I think if the cycle plays out, it would surprise the most bullish optimists.
Okay, Dr. Yadeni, just coming out here, I mean, this point that Naresh is bringing about how retail largely has been absent in the most, in a real way. I mean, yes, retail is out there buying, etc., but not quite in the same way, because the charts show that the holdings are not quite there. Is that something that is to follow? Is that a thesis for your bullishness as well? And are you, when you are laying out the targets, sir, are you optimistic? Are you very measured in your approach, or are you conservative currently?
Well, I have to say, I have never recommended gold. I'm not a gold analyst, and that's because I'm a fundamental analyst. When I look at assets, I have traditionally needed to look at assets that have earnings, an interest income, a coupon payment, right, rent. So that's been my kind of the neighborhood where I've lived. But I do look at gold, I look at commodities, and again, I think it's fairly straightforward that central banks. I hope that retail doesn't come in too soon, and that's because sometimes when you get too much excitement at the retail level, that can be a contrary indicator. It can suggest that too much buying, too much bullishness actually sets us up for a bearish situation. I think retail has been buying stocks around the world, particularly in the United States. I think retail has been buying Bitcoin, and I think both of them are disappointing now. And gold, meanwhile, has been remarkably steady in its rise. It's been kind of a get rich slow asset, and so far so good.
Yeah, Dr. Yadeni, is there a how do I say a second level or a third level thinking that should go or could go into why is it that central banks are buying gold the way they are? I mean, China's accumulation is quite stunning, and when I looked at data from 2020 to 2024, half expected Indian central bank to be there. It is at number 2, China at number 1, but a clutch of other central banks too have been buying here. Is there a second level or a second order thinking required here on this?
Well, I think you might have mentioned it, and that is that we're going back to kind of a historical period where gold was widely viewed as a very important reserve asset. And while everybody's arguing whether the dollar is going to remain a reserve asset, whether other currencies, the BRICS have been talking about creating their own currency, it turns out that good old-fashioned gold is turning out to be probably the best reserve currency available. I don't think it's Bitcoin. And I think to the extent that central banks recognize that they don't want to legitimize Bitcoin as a reserve asset, because actually Bitcoin creates a potential challenge for the central banks. Gold, on the other hand, doesn't create any challenge for the central banks as long as the price goes up. And they just continue to buy it steadily. They're not price sensitive, because the reality is you really can't come up with any sort of present discounted value for the price of gold. But as we've been saying, history shows that it continues to go up, and its corrections are fairly benign. It doesn't have violent corrections. There are times when it has kind of a long-term slow bear market, but those are followed by slow bull markets. And if you get in early, it's worked very well in the past for accumulating net worth with the ability to fall asleep at night.
Quick follow-up, Dr. Yadeni. The dollar index, there are a lot of people talking about how the DXY over the next 12 months, maybe 24 months, could actually decline quite significantly. And the jury is out there, but I'm just trying to understand, what's your view there? And could that also have a linkage to gold prices?
I'm not in that camp. I think the dollar is going to remain strong. It's just been volatile for the past couple of years around this level. So I don't see that there's anything particularly important going on in the currency markets. I mean, clearly the euro has been stronger, and because of more fiscal spending in Europe, the yen has been stronger because of. All in all, no, I don't think that the dollar is going to fall. Obviously, if the dollar were to fall, that would be even more bullish for gold. But I would prefer to have a nice leisurely increase in the price of gold, which is what I think we're seeing.
Yeah, and that's probably always desirable. But Naresh, are there any other points? Because I was seeing a presentation that you made at a recent investor forum, right? And you've spoken about the reserves that are held with various governments or central banks as well, and how there could be theories around those two, and could that prove to be another leg up giving factor for prices of gold?
So yes, that is one. I think central banks may be accumulating more than what they're disclosing because they don't want to scare people into gold. The foreign exchange data of imports export is kind of alluding to that. And so yeah, I think there's another very, I think, bullish factor, again, of the regular mainstream media coverage, is the amount of gold on lease. So that's technically a short position, and I'd certainly like to have Dr. Yardeni's view on that. So most depositories holding gold, which is Bank of England or the US federal system, they lease gold. So if you know that our Indian jewelers have something called as a gold metal loan, they borrow gold in physical at very low rates. I really never could understand what the source of that gold is, because banks lease that gold, but banks don't own that gold on their books because gold is not a asset recognized under Basel III. So they don't really own gold under their capital. So that's a little bit of an intriguing thing to me, and I think it's potentially a short position, which at some point of time will need to be covered. And I think it is manifesting in the discussion which is happening on the need to audit Fort Knox gold, or the delays in Bank of England dispersing or giving away the request for its custodial gold position. So yeah, there's some other factors in play, but yeah, probably time will tell how it plays out.
Okay, so, well, I don't know if Dr. Yardeni would have that view or no, but since you asked, let me ask Dr. Yardeni. Dr. Yardeni, any thoughts on that?
No, I was very interested in the point that you just made about the leasing issue. I wasn't really aware of that, but that's fascinating, and it may very well be, in effect, a short position. I agree with you that gold has been sort of out of fashion in central bank parlance. They don't really want to talk about it. They'd much rather say that their reserves are in dollars, euro, or yen, and they don't tell you what's in gold. Even the IMF has a data series which is reserves excluding gold. But if gold continues to shine here and makes a comeback as a legitimate reserve asset, then I think you're going to maybe find that banks that were playing games with leasing will just be outright buyers. Another thing I'd point out is it's hard to say, and maybe you both know what the Chinese individual is doing with gold, because the Chinese individual has gotten absolutely hammered in their real estate. They've got a huge negative wealth effect in real estate. They have not done well in stocks. Since the beginning of the year, stocks have done better for them, but it's been very volatile for them. And my hunch is that there is a lot of Chinese buying of gold by retail investors.
Wow. Well, I must say, one book within the hundreds behind Dr. Yardeni might have some inkling on that too, I must say. But Naresh, quickly, any thoughts here? Dr. Yardeni made a very interesting point. I mean, anything that you've read around the Chinese individual behavior, investors' behavior? I know Indians are buying. What about China?
So as of now, the demand is from central banks. Chinese retail is, I believe, a small part of the overall scheme of things. It's more the central banks and then the retail. India is bigger. India is 20% of world gold imports. World manufacturing per annum, whatever is manufactured, 3,600 tons. India imports about 750 tons a year. Indians have been kind of steady.
Yeah.
They've not really increased. In fact, imports are down from 2010, 11, 12 to what it is now. So I believe the drivers are more central banks, and then retail comes in. But I have just one more important point to make on how gold works on the Indian markets. I think we have a big impact of gold on Indian markets, unlike any other country in the world, because the stock of gold we hold is almost equivalent to our GDP or market cap. No other country has this setup. Total stock of gold in India is about 35,000 tons, which is $3.5 trillion. That's our GDP. That's about our market cap. So a gold rise actually leads to a wealth effect, which doesn't happen in any other country. And the data I've analyzed over the last 25 years, after a 30% rise in gold, which has happened multiple times in the last 25 years, Indian markets tend to do well. The average small cap index performance was 25% per year after a 30% rise in gold versus long-term average of 15%. And of course, I don't have too much data because Indian rupee during the last bull market between 2000 and 2011 was flat, while gold had a 7x rise. So, but that's only one cycle. I would want to watch how it did this time, how will it do this time. But apparently, India does well when gold rises.
Let's hope that happens. Naresh, one final takeaway, because Dr. Yardeni has given his. I'm not asking you to make a prediction, but are you constructive gold for somebody to looking at this show right now? Good to go out and invest in gold? Your hypothesis?
So I would view it more as at least as an insurance,
of course,
portfolio insurance,
well, which is a given.
Yeah, which is not always, I think, a given, because at some times gold underperforms. It's a drag.
But Naresh, 15 years, Sensex and gold prices have nearly matched returns, right? So data shows that it's a given. Whether people do it or no is separate, right?
True. So good point. I think that that also depends on your starting and ending points. Between, let's say, 2010 and 20, gold underperformed massively Indian markets.
Okay.
So all this long-term tracking is because gold has done well recently. Long-term things look good. But yeah, I'm constructive. I think there are a lot of tailwinds which are playing out for gold. Gold moves in very long-term cycles. At best, at the minimum, it could be an insurance, but I think it could be a very good portfolio diversification and addition.
Well, gentlemen, both of you, this was a fascinating conversation. I learned so much about so many things. So Dr. Yardeni, indeed a pleasure as always, and thank you for staying up so late for this conversation with us. Really appreciate your time.
Thank you.
And Naresh, thank you so much for flying down all the way from Chennai for talking to us on this. It's been fascinating talking to you.
Real pleasure and very insightful discussion with also Dr. Yardeni.
As always, I would say. But great having you after a long time on television.
My pleasure.
Yep. And viewers, thanks for tuning into this conversation. I hope it helps you in your portfolio metrics.